Your phone buzzes. You open your investing app. Red numbers everywhere. The market is crashing. Your portfolio down 10%, then 20%, then even more. Your stomach drops. News channels start repeating the same words again and again. Market panic, historic sell-off, investors rushing to exit. And suddenly a thought appears in your mind. Maybe I should sell everything before it gets worse. If you've ever felt that moment of panic, you're not alone. It has happened to millions of investors throughout history. During the Wall Street crash of 1929, during the 2008 financial crisis, and again during the 2020 stock market crash, every time the same fear spreads. Every time people believe the system is collapsing. But the most important lesson from every crash is this: the biggest financial mistakes usually happen after the market falls, not before. So today, let's talk about something incredibly important, not predicting crashes, but what smart investors actually do when a crash happens. First, we need to understand something about human psychology. Your brain is designed for survival. Thousands of years ago, that helped humans avoid danger. But in modern finance, that instinct often works against us. When markets rise, people feel confident, but when markets fall, fear spreads incredibly fast. Psychologists call this loss aversion. Losing money feels about twice as painful as gaining the same amount. So when your investments drop 30%, your brain screams one message: escape before it gets worse. But here's the problem. That instinct is exactly what causes many investors to lock in permanent losses. If you look at financial history, crashes are not rare events. They happen again and again. But something interesting happens after them: recovery. If you zoom out on the long-term history of the S&P 500, the market has experienced wars, recessions, pandemics, and financial crises. Yet, over long periods, the trend has continued upward. That doesn't mean every company survives, but the overall market has historically recovered. And this is where many investors make their biggest mistake. They sell during fear and miss the recovery. During a crash, panic selling feels logical. It feels like protecting yourself, but often it does the opposite. Imagine someone who sold their investments during the worst moments of the 2008 financial crisis. At the time, the financial system looked like it might collapse. Banks were failing, markets were dropping daily. But investors who stayed invested eventually saw the market recover in the following years. Those who sold near the bottom often missed one of the strongest recoveries in history. One of the most powerful tools investors can use during a crash is perspective. When you look at daily market movements, everything feels dramatic. But when you zoom out to 10, 20, or even 30 years, crashes often appear as temporary dips. Long-term investors understand something simple: short-term volatility is the price paid for long-term growth. That doesn't make crashes comfortable, but it helps you understand their place in the bigger picture. Here's something that sounds strange at first. Market crashes can actually create opportunities. When fear spreads, prices fall. That means strong companies sometimes trade at cheaper valuations. Many investors who built large portfolios did something counterintuitive during crashes. They kept investing, not recklessly, but consistently. Over time, this strategy is often called dollar-cost averaging. Instead of trying to predict the perfect moment, investors simply continue investing steadily over time. Crashes also reveal something important about your portfolio: your risk tolerance. Many people believe they can handle volatility until the market drops 30%. If a crash makes you panic, it might be a sign your portfolio carries more risk than you're comfortable with. Some investors reduce volatility by diversifying across different assets, such as stocks, bonds, or other investments. The goal isn't eliminating risk completely. That's impossible. The goal is building a portfolio you can hold even during difficult times. Another reason people panic sell during crashes has nothing to do with investing knowledge. They simply need the money. Unexpected expenses, job loss, or financial pressure can force investors to sell during the worst possible moments. That's why many financial planners emphasize having an emergency fund. Cash reserves give you flexibility. They allow your investments time to recover instead of forcing you to sell when markets are down. Every crash creates headlines. Every crash spreads fear, but every crash also teaches the same lesson. Investing is not just about numbers, it's about behavior. Two investors can own the exact same assets, yet one panics and sells, the other stays patient. Years later, their results can be completely different. Stock market crashes will happen again. That's not speculation, it's history. Markets rise, markets fall, and then they recover. The real question is not if the next crash will happen. The real question is this: when fear spreads across the market, what will you do? Before you go, I want to hear something from you. Many people watching this video have their own financial stories. Maybe you experienced a market crash. Maybe you made a mistake with money, or maybe you learned an important lesson the hard way. Share your story in the comments. We read every single one, and some of those real stories may be selected and turned into future animated breakdowns on this channel. Your experience could help thousands of people avoid the same financial mistakes. So, if you have a story about money, investing, or financial struggles, tell it below. Your story might become the next video.